Never forget this number. 10 years in prison for owning the wrong metal at the wrong time. And the scary part is this. The exact playbook that made that possible has quietly been rebuilt for the years ahead. In the next few minutes, you're going to see how the US government once turned ordinary people into criminals for owning gold and silver, why silver didn't actually escape the trap, and how the modern version wouldn't look like agents knocking on doors at all. By the end, you'll understand the risk most silver investors never think about. Not loud confiscation, but a slow, quiet squeeze that works so well most people won't even realize what's happening until it's too late. Let's start with a story that sounds exaggerated. Except it's not. It's real history. It's April of 1933. The Great Depression is in full force. Almost 1 out of every 4 Americans is unemployed. Banks are collapsing weekly. Lines stretch down city blocks as people try to pull their savings out before the doors close forever. Trust in the system is gone. So people do the most human thing possible. They protect themselves. They withdraw cash. They convert paper into gold coins. They hide wealth where it can't vanish overnight. At the time, that reaction made perfect sense. The US dollar wasn't just paper backed by faith. It was legally tied to gold. The Federal Reserve was required to hold gold reserves behind the currency it issued. That meant something critical. Every ounce of gold that disappeared into private hands made it harder for the government to expand credit, print money, and stabilize the collapsing system. From Washington's point of view, gold hoarding wasn't just personal protection, it was an obstacle. So the government didn't try to persuade people, it didn't debate, it didn't negotiate, it forced the issue. President Franklin D. Roosevelt signed Executive Order 6102 with the stroke of a pen. Owning more than a small amount of gold became illegal. Gold coins, gold bars, gold certificates. All of it. Americans were given just weeks to comply. Turn in your gold to a bank or the Federal Reserve at a fixed price, or face up to 10 years in prison and a massive fine. A fine so large it would equal well over $100,000 today. There were exceptions, yes. A small amount of collectible coins, gold used in certain professions like dentistry or jewelry, as long as it was properly licensed. But don't get distracted by the loopholes. The message was unmistakable. Your gold no longer belonged to you. It belonged to the system. People walked into banks carrying what they believed was real money. They walked out holding paper promises. And then came the move that almost nobody mentions. In 1934, the government passed the Gold Reserve Act. The official price of gold was raised from about $20 an ounce to $35 an ounce. Think about what that actually did. Citizens were forced to sell their gold at the old price. Then, immediately after, the government revalued gold higher. Overnight, the paper people had just received lost a huge chunk of its purchasing power, while the gold sitting in government vaults became far more valuable. This wasn't a side effect, it was the entire point. And if you think silver somehow escaped this story, it didn't. It just played out a little differently. In August of 1934, Roosevelt signed another executive order. This time, the target was silver. Americans were ordered to deliver refined silver bullion to the U.S. Mint within 90 days. Prison time and heavy fines were once again on the table. Circulating silver coins were mostly exempt, but silver bars, stockpiles, and large private holdings were not. Why silver? Because Congress had passed the Silver Purchase Act. The Treasury was instructed to build silver reserves until silver made up roughly a quarter of the nation's combined gold and silver holdings. They needed metal, real metal, to support the monetary system. So silver was pulled in. More than 100 million ounces flowed into government hands. People were paid near market prices at the time, around 50 cents an ounce. But if you made a profit on that silver, the government could slap you with a windfall tax as high as 50%. Notice the pattern forming. The government didn't always need to kick down doors. It didn't need mass raids. It simply made holding the asset uncomfortable, risky, and financially unattractive. And here's a detail that matters more than most people realize. This system worked largely because of fear and compliance, not force. The government didn't have the manpower to search every home or dig up every backyard. Instead, it targeted large, visible holders. It made examples. And the rest of the population mostly complied because they believed it was necessary or because they were afraid not to. Now here's the real question. Why does this matter if you own silver today? Because the conditions that made those decisions possible didn't disappear. They just changed shape. Fast forward to the present. The United States is now sitting on over $30 trillion in debt. That's more than $100,000 per person. Hundreds of thousands per household. The interest alone is approaching $1 trillion a year. Debt is well above 100% of GDP. Levels historically associated with wars, depressions, and systemic resets. This isn't about politics. It's math. To keep this system functioning, the government needs control over capital. It needs money to stay inside the system. It needs the ability to borrow, print, and move funds quickly when stress appears. Anything that lets people store value outside that system becomes a threat. That's where silver enters the picture again. Physical silver exists outside digital banking. It doesn't depend on servers. It doesn't rely on third parties. It can't be frozen or deleted with a keystroke. By its very nature, it's an opt-out. So when people ask, could they confiscate silver again? They're asking the wrong question. The better question is, how would they discourage silver ownership without ever calling it confiscation? Because here's the uncomfortable truth. A dramatic 1930s-style seizure is actually unlikely, and that's exactly why the modern approach is more dangerous. Today, silver ownership is fragmented. Millions of people own small amounts, coins, rounds, small bars, junk silver. Trying to physically seize all of that would be a logistical nightmare. Legally, it would be explosive. Any obvious confiscation attempt would be challenged immediately in courts. Media backlash would be intense. Political consequences would be severe. And globally, capital is mobile. Storage options exist outside national borders. If one country pushes too hard, money moves. Governments know all of this. So instead of taking your silver, they shape the environment around it. They make it harder to sell, harder to move, more expensive to use, and they already do. In the United States, physical silver is taxed as a collectible. That means long-term gains can be taxed up to 28% higher than the rates applied to stocks or many other investments. That's not an accident. It's a policy choice. Certain silver transactions already trigger reporting requirements. Dealers file forms. Thresholds exist, and those thresholds can be lowered at any time. You don't lose your silver. But the moment you try to convert it into dollars, the system takes notice. Now layer digital payment systems on top of that. Instant settlement rails already exist. Transactions can be tracked in real time. Globally, dozens of countries are actively testing or rolling out central bank digital currencies. Some have already launched them. A digital system doesn't need to outlaw silver. It just needs to add friction. Large transactions require approved channels, extra documentation, delays, additional taxes, anti-money laundering rules, financial stability measures. You can still own silver, you can still sell it, but every step costs more and reveals more. That's not confiscation. It's economic pressure. And historically, it works extremely well. Now let's talk about silver itself, because this is where things get complicated. Silver isn't just a monetary metal. It's an industrial one. More than half of global demand comes from real-world uses. Solar panels, electronics, medical equipment, electric vehicles, data centers, and communications infrastructure. That matters. It means silver can't be easily sidelined without consequences. Governments need it for the future they're trying to build. Energy transitions, technology growth, and infrastructure plans all depend on silver. At the same time, the silver market has been running a structural deficit for years. Demand has exceeded supply. Hundreds of millions of ounces that should exist simply don't. And supply isn't flexible. About 70% of silver production comes as a byproduct of mining other metals. You can't just double silver output because prices rise. This puts silver in a strange position. It's critical. It's scarce. It's small enough that investment flows can move prices fast. And it still functions as monetary insurance. That's why some governments are paying attention again. But here's where the real challenge appears. And this is the part most silver holders avoid thinking about. A lot of people treat silver like a magic escape hatch, like it automatically solves systemic risk. But ask yourself something simple. How are you actually going to use it? Are you selling into a system with heavier reporting and higher taxes? Are you moving it across borders under tighter customs rules? Are you trading it locally while digital payments become the default? If the plan is, I'll figure it out when I need to, that's not a plan. That's hope. This doesn't mean silver's a bad idea. It means strategy matters more than stacking alone. Price risk is obvious. Silver is volatile. That's normal. Access risk is the silent one. The risk that your silver is valuable on paper but expensive, slow, or painful to convert into real-world purchasing power. That's the risk history keeps warning us about. In the 1930s, the government didn't just seize assets. It reshaped incentives. It made compliance easier than resistance. It made alternatives costly. Today, the tools are different, but the logic is the same. So when you look at silver now, the real question isn't whether it will go up or down next year. The real question is whether you understand the rules of the game and how those rules might change. Because history doesn't repeat word for word. It rhymes. And if you want to understand how to build a silver strategy that actually works in a world of rising debt, digital money, and quiet policy shifts, watch the next video on your screen. If you have thoughts on today's topic or something you'd like me to dig deeper into, feel free to leave a comment. I always appreciate the conversation. And if you found this helpful, go ahead and like the video, subscribe, and turn on notifications so you don't miss the next update. See you next time.